European markets are appearing to rebound after Switzerland's embattled bank, Credit Suisse, secured a big financial lifeline. Now, concerns over the troubled lender had earlier sent Asian stock markets falling. Credit Suisse has said it will borrow up to 50 billion euros from Switzerland's central bank in a bid to shore up its liquidity, meaning how much cash it has on hand to finance its business. Now, the sudden collapses of two US banks last week have sparked growing fears worldwide.
Jitters on the market sent many Asian stocks into the red again on Thursday. Investors are warily eyeing the problems that have hit several banks in the US and Europe, wondering if they're just the first signs of a deeper crisis. The latest alarm bells have been sounding around Credit Suisse, one of Europe's largest banks.
From a macroeconomic perspective, Credit Suisse is major global player, major player in the US, smaller than it used to be, but still very important.
Shares of the Swiss bank plunged to a record low on Wednesday after its biggest shareholder said it would not provide more funding to the company. The dive prompted the Swiss central bank to step in to support Credit Suisse, making it the first major global bank to receive such a lifeline since the 2008 financial crisis.
Credit Suisse has a lot of links to the financial sectors of other countries. So it has operations in the US, in other parts of Europe, and more widely around the world. And it will have a lot of creditors and subsidiaries elsewhere who potentially could get into difficulties if Credit Suisse in Switzerland were to have trouble.
Analysts say balance sheets across the entire banking sector are now facing greater scrutiny after the failures of Silicon Valley Bank and Signature Bank in the US.
They're searching for weakness across all, banks, including Credit Suisse. So the risk is not off the table. And across the horizon, people are trying to think about, what does this really mean for the banking industry as a whole?
Yeah, I'm really keeping a close eye on Credit Suisse. That to me is really, much more concerning. And depending on how that works out over the next, couple of days and even this weekend, I do think that is something that certainly can have, very broad implications for the market and, the global financial system.
By quickly taking decisive action to shore up Credit Suisse, the Swiss central bank is hoping it can prevent the crisis of confidence from spreading.
Well, let's discuss the situation at Credit Suisse with Florian Haider, an economist at the Leibniz Institute for Financial Research, SAFE. Thanks a lot for joining us on the programme. Markets were calmed by news that Credit Suisse was seeking this help from the central bank. But does Credit Suisse have a liquidity problem?
Hello. Any bank will have a liquidity problem if those which have deposits at once and altogether take the money out. So in theory, any bank, if it is being ganged up on by depositors, could fail. Now, fundamentally, the numbers at Credit Suisse are not looking worse than it would be for a bank that doesn't look to be particularly well managed. I mean, it has lost a lot of value over the last year, not just the last few days. It's lost 70% of its share price in the last year. And so, yes, it is a bank that is in trouble, but yes, it's also a bank that seems to be doing the right things to get out of it. So injecting some liquidity is the usual thing that's been done. And my guess is that if they can turn around the business model, they should be fine in the future.
And that's what they've said is what they're doing. But how much can what we've seen with Credit Suisse over the past 24 hours be linked to what we've seen over in the United States with Silicon Valley Bank and Signature Bank over the weekend?
There is a link. As always in these financial crises and banking crises, many things have to come together, and in some sense, the Silicon Valley Bank, that was just the spark that ignited the situation. Why? Because we have two underlying issues here. We have on the one hand that European banks generally have underperformed relative to US banks over the last few years. So they're not in the best shape. They're all struggling. Add to that the massive change in interest rates. The euro area has seen the highest rise in the interest in its policy rate since the existence. Put these things together and add a bank that has reminded people that duration risk is a real thing. It's not surprised that in Europe people look at various banks, and then if you have the weakest link in the chain, which would be Credit Suisse, because it has been underperforming over the last few years, that bank will be in trouble.
From what you're saying, it sounds like we should be worrying about more than just Credit Suisse here in Europe. So if the worst were to happen with Credit Suisse, and we did see some sort of collapse, would that lead to collapses elsewhere?
Not necessarily. But any bank has a liquidity problem because they lend long and borrow short. So again, if for some reason depositors all get together and take the money out and coordinate on that, that's the key thing, coordination, then any bank that has engaged in any kind of business risk to make some money will be in trouble. So the key is, how can we prevent this panic, or management at banks sending signals that would allow the depositors to coordinate? I mean, it's not, in my view, a particularly smart idea to, when you're in trouble, ask for money and have not prearranged this money coming in, so that you are then in a situation, I've asked for money, I've asked for more equity, and I'm surprised that no one will be putting this up. To me, that is, that sounds a little bit short-sighted. So
yeah,
yes,
people would rather see that you were prepared than reactionary, I suppose. People are obviously naturally thinking about Lehman Brothers, and they're thinking about 2008. It's 2008. Just briefly, are things different to 2008?
Yes, they are different in two dimensions, but there's one common theme, and I think that's why people are a bit worried. So the differences are the nature of the problem is very different. I mean, right now we're probably talking mostly about interest rate risk, about products that are very transparent. People can figure it out easily. Before, it was securitizations. Nobody even know what that stuff was, even the banks themselves. And second, bank regulation has made significant progress over the last few years. We have better capital regulation, better liquidity regulation. We have stress tests. Yes, all of this is imperfect, but it's miles better than it used to be. Okay. The common theme, however, is that we're seeing a relatively rapid rise in interest rates and policy rates after a period of very low interest rates. And that will always upset financial markets somewhat. And to be honest, I am somewhat surprised that we haven't seen more yet, because we've seen raising interest rates for the last 1.5 years.
Well, indeed, it's a very different climate. I'm sorry to interrupt you, Florian Heider, but we are just out of time. But thank you very much for joining us here on DW Business.
You're welcome.